Trump's proposed tax bill contains a single provision that could legally save real estate investors hundreds of thousands of dollars on their next investment. Most investors, they have no idea that this opportunity exists. Hi, I'm Dr. Jeff Anzalone, and I've spent weeks analyzing the exact language in the big, beautiful tax bill that could create a once-in-a-generational wealth-building window for property investors from 2025 through 2029. Now, before I go any further, this isn't about politics. It's about a specific tax provision that would allow real estate investors to write off 100% of certain property costs in the first year instead of spreading it out over decades. And in the next few minutes, I'm going to reveal exactly which provisions matter the most and how to actually position yourself to potentially benefit from what might be the most investor-friendly tax package that we've actually seen in our entire lifetime. Let's move on to provision number one. And it's actually, in my opinion, for real estate investors, the most important. So let's just go ahead and start off with that. And that is this, the 100% bonus depreciation extension. This, as you probably know from some of my other videos and articles, this is the crown jewel for real estate investors. The bill explicitly states that it would allow taxpayers to immediately expense 100% of the cost of qualified property acquired on or after January 20th, 2025, just a few months ago, and before January the 1st, 2030. So basically from 2025 to the end of 2029. So here's actually what this means in plain English. So instead of you depreciating property, and straight line depreciation is anywhere from 27 and a half years for residential property or 39 years, because who wants to wait 27 and a half or 39 years? You could potentially write off 100% of the qualified components in year one, in the first year of ownership. So when you take this and you combine it with the cost segregation studies that we've talked about multiple times, this could allow investors like you to actually accelerate depreciation on anywhere from 25 to 35% of a property's purchase price in year one. That's big stuff. Actually, in one of my mobile home park syndications, we actually use cost segregation to write off about 30% of the investment basis. So if you look at it in that example, on a $200,000 investment, this produced roughly around $60,000 in paper losses. So for somebody that's in let's say the highest tax bracket, somebody's in a 37% tax bracket, that's a potential savings of $22,000 in year one. And an instant 11% instant return from tax benefits just alone. On top of what do you typically get from real estate? Cash flow. All right. Before I go any further, I'm a dentist. I'm not a CPA. I'm not a tax strategist. Don't take this as financial or tax advice. But what I'm telling you, and I went through and I specifically looked at the different provisions and how this could relate to us real estate investors. Some of the things that I'm recommending, again, do your own due diligence, talk with your tax strategist or your CPA about it. But in this case, something that you could consider is actually front load real estate investments during this, remember, 2025, 2029 window. I'm actually personally increasing my allocation during this time to maximize this benefit. Moving on to the provision number two. You've probably heard this before, especially if you're a business owner, Section 179. It's actually going to be expansion. So this provision increases this deduction limit from 1.16 million to 1.29 million for actually this year in 2025, with actually a phase out threshold beginning at 3.22 million. While it's not as dramatic as the bonus depreciation, this still creates a significant opportunity for real estate investors, especially for us that are focused on value add properties. So what does this mean? Well, this means that you can actually deduct more improvement costs immediately rather than, again, waiting and depreciating them out over time. So this is going to create a larger upfront tax savings that can either be reinvested for compound growth or whatever you want to do with it. We actually have an RV park investment that I participated in. We spent about $500,000 on improvements. We did some renovation on the clubhouse. It had some new electrical hookups, upgraded the landscaping, things like that. Now, with this expanded Section 179, we could potentially deduct the majority of these improvement costs right up front. So one of the things that you can consider if you're looking at this is you can actually start focusing on value add properties that actually require significant improvements. This is going to be a good way to benefit from these tax improvements. Provision number 3. Again, I've got multiple videos on this as well, and this is going to be about opportunity zones. We're actually going to expand this. They're actually going to reestablish this, okay? So this bill would establish actually a second round of opportunity zones for taxable years, actually go from 2027 to 2033 with similar benefits to actually the current program. This is going to allow you to defer capital gains taxes by reinvesting gains into designated economically distressed areas, potentially eliminating taxes on the new investments appreciation if you hold it in these for at least 10 years. So what are you talking about, Jeff? Speak to me in regular language. Okay, so let's say you've got $300,000 in capital gain. Let's say you sold some stocks or mutual funds or something like that. You've got a tax bill for $300,000. All right. Instead of paying roughly around $71,000 in capital gains taxes, well, I'm actually assuming a 23.8% tax rate, 20% plus the 3.8. You could actually, instead of paying that, you could actually reinvest the full $300,000 into an opportunity zone project. There's funds out there, that sort of thing. Now, let's say that investment grows at 8% annually for 10 years, then you'd have, from the 300, you would have $648,000 under this new program. So that the appreciation, the $348,000 that you would have made from the 300 would be completely tax-free. That's a potential savings of roughly like $83,000 on the appreciation alone. Plus, again, the deferred tax on the original gain of $300,000. So one of the things you could do is actually start identifying potential capital gains that you have in your portfolio that maybe you're going to realize these in, let's say, 2026, 2027, and then you can start researching if there's any quality opportunity zone fund managers now, so you're ready when the next designations are announced. Moving on to provision number 4. This has to do with permanent tax cuts. The top tax bracket actually remains at 37%, avoiding a reversion to the pre-2017 rate of 39.6%. So this actually is going to give you more long-term planning certainty, okay? So for instance, let's say on $100,000 of annual real estate income that you got coming in, well, this lower rate's actually going to save you $2,600 a year or $26,000 over a 10-year if excluding compound growth. So whenever you're using strategies like bonus depreciation, cost segregation to create the paper losses, every dollar of deduction saves you 37 cents instead of the 39.6 cents. Now, that might seem small, but on large real estate investments, this difference compounds quite dramatically. Moving on to number 5. And the 5th provision is Section 199A, Enhancement. This would actually increase the qualified business income deduction from 20 up to 23% and make it permanent. So this deduction applies to flow-through businesses, including many real estate entities. So if, again, we talked about $100,000 of qualified real estate income, this increases your tax deduction by $3,000. Remember, from 20 to 23%. So for a 37% taxpayer, that's an extra savings of about $1,100 each year per $100,000. So consider structures that actually qualify for this QBI. It's also known as qualified business income. So consider structures that qualify for this, things like a lot of times direct ownership, or there's actually certain syndications, typically not REITs or debt only funds, Provision number 6 is the SALT cap increase. SALT cap increase. What does that stand for? SALT is the state and local tax, okay? State and local tax deduction cap. So this is actually going to increase from $10,000 to $40,000 per household for those that have a AGI or an adjusted gross income below $500,000. Above that threshold, the cap actually reverts back to $10,000. So if you're an investor and let's say you're in a high tax state like California, this could actually free up quite a bit of capital for additional investments. But however, in using this provision, you must itemize your deductions to benefit. And a lot of times for many people, just the standard deduction may still be better unless your total itemized deductions go over $30,000. All right. Moving on to provision number 7, last but not least, and that is excess business loss limitation. Excess business loss limitation. The limitation on excess business losses for non-corporate taxpayers will be made permanent. Currently, they're set at around $289,000 for married filing jointly, and this actually limits how much business loss can offset other income in a given year. With excess losses, you can carry forward. So instead of making one large $500,000 investment that generates significant paper losses in a single year, many of which may be limited, spreading out maybe 5 individual $100,000 investments over 5 years can allow you to utilize more of the tax benefits, potentially saving you tens of thousands in taxes. So we've got all these provisions. Again, there's a lot more in there. I just wanted to more focus on the real estate and business sort of provisions. Putting all this together, how can you come up with an action plan? Well, if this bill becomes law, which it looks like it's going to, real estate investors could have, as you can imagine, amazing opportunities to build wealth faster, in my opinion, than ever before. The 100% bonus depreciation, better tax deductions, and new opportunity zones could work together, all come together for you to create some serious wealth. Here's what I recommend. Start getting ready now. Remember, I'm a dentist, I'm not a tax strategist. Work with your CPA or tax strategist now, even though this is still just a proposal. Build relationships with good real estate operators, companies, syndicators, these types of people, okay? If you don't already have to do that, click the link below this video. We have a passive investor circle that allows you to invest alongside of me in the investments that I'm in, RV parks and mobile home parks. If you have somebody in your area that you could partner with, whatever, again, just start building a relationship. So if these tax changes happen, having these connections will be huge when this window opens. Remember, from 2025 to the end of 2029. Think about your investment timeline. If you've been considering buying more real estate, the next 5 years could be the perfect time. But remember, tax laws, they always change. The basic benefits of real estate investing stay the same though. Monthly cash flow, property value going up, the tenants, your tenants are going to be paying down your loans, and of course, tax breaks. These new changes would just make those benefits even better. And I can actually tell you from personal experience that smart tax planning plus good real estate deals can help you reach the point that work is optional much sooner than you think. Now, if you want to learn more about how you can continue to build real wealth, no matter where you are in your journey, do me a favor, check out this video.